All right, let's talk about something that sounds super complicated, but is actually built on a really simple idea: futures trading. At its heart, it's all about trying to control tomorrow's prices today.
I mean, seriously, have you ever wished you could lock in the price of gas for the whole next year, right now? Or, if you were a baker, wouldn't it be amazing to secure the price of wheat for all your bread before it's even been harvested? Well, that's exactly the big idea behind a futures contract.
Think of it like a legally binding handshake for the future. You've got a farmer, right? And they're worried the price of corn is going to drop by the time they harvest. So they can use a futures contract to lock in a selling price with a buyer today. They agree on everything: the price, the amount of corn, the delivery date. And just like that, a huge piece of the farmer's uncertainty about the future is just gone.
But, beyond that simple idea, the way these things actually work is kind of fascinating. So we did a deep dive, and we pulled out 3 really surprising facts about them that you absolutely need to know.
Okay, first up is the incredible, and I mean incredible, power of leverage. In the world of futures, you don't need a mountain of cash to control a mountain-sized asset. Nope, all you need is a pretty small deposit.
And this slide really nails the idea with that seesaw image. See that? On one side, you've got your small deposit, which has a fancy name. It's called margin. But on the other side, you're controlling a massive position in something like gold or oil. That little bit of money gives you control over something worth way, way more.
What this really means is that with just a tiny fraction of the total contract's value sitting in your account, you get the full exposure to all its price swings. So, a tiny little upward tick in the market price, it can create a huge percentage gain on your initial deposit. But, as you can probably guess, that power, it cuts both ways.
And that, of course, brings us to the other side of that seesaw, because the exact same force that can launch your profits into the stratosphere can also send your losses crashing down with just staggering speed.
So if we look back at our chart, you can see the flip side right there, under magnified risk profile. Because your deposit is so small compared to the position you're controlling, a tiny market move against you can completely wipe out your entire deposit. And in some cases, you could even end up owing more. The risk is just as magnified as the potential reward.
So our second surprise is just how serious these contracts are. This isn't like a stock option where you have the right to buy something but not the obligation. Oh no, a futures contract is an ironclad promise.
Just let that sink in for a second. Once you're in, you are in. There is no opt-out button. You can't just change your mind.
And right here, under the binding obligations section, you can see it's a mandatory commitment. If you buy a futures contract, you are legally required to buy the asset. If you sell one, you must sell it. Now, in the real world, most traders just sell their contract to somebody else before that delivery date ever comes. But it's that underlying legal promise that gives this whole thing both its power and its risk.
All right, so after all that talk of risk and obligation, here's the surprising potential upside that a lot of people just don't know about. And that's the unique way futures are taxed, at least here in the United States.
It all comes down to a really special tax rule, and it starts with this number, 60%. Just keep that number in your head for a second.
And here is the other part of that rule, 40%. So you've got 60 and 40. What on earth could that possibly mean for your taxes? Well, it's called the 60-40 rule, and honestly, it's a huge deal for active traders. No matter how long you hold a futures contract, you could hold it for just a few minutes, 60% of any profit you make is taxed at the lower long-term capital gains rate. Only 40% gets taxed at that higher short-term rate. When you compare that to trading stocks, where any gain from a trade you hold less than a year is taxed at that higher rate, this can be a massive, massive advantage.
So when you put it all together, you've got the high leverage, the binding contracts, and these really unique tax rules. You start to see that futures are, well, a truly double-edged sword.
So let's just do a quick recap of our 3 surprising facts. First, we learned about leverage, that incredible power that can magnify both your wins and your losses. Then, we found out that these things are binding contracts. They're a firm commitment, not just an option. And finally, we uncovered those unique tax rules that can offer a real silver lining for traders. It's a tool for hedging risk, like for our farmer, but it's also a tool for high-stakes speculation.
From the price of corn in your pantry to the future of oil for your car, these contracts are a powerful, risky, and pretty fascinating tool that's shaping our economy every single day. Now that you understand the leverage, the commitment, and the perks, the real question isn't just what role they play in the world, but how this knowledge changes how you see the financial world.